Welcome to No Nonsense Nonprofits. Hi, I'm Sandy Ray, founder of Sandra E. Ray CPA, where we alleviate financial headaches so that you can create a bigger impact. Today, we're talking about deferred versus restricted revenue in not-for-profit accounting. It really matters because it impacts our reporting. It tells us what we're legally allowed to spend. It impacts our audits and, of course, strategies and decision making, because we know how much of the cash that we have is available for specific areas and for operations. Now, revenue recognition is governed by generally accepted accounting principles, specifically FASB Accounting Standards Code 958. There's common confusion even among experienced nonprofits. The core principle is deferred revenue means we have obligations. We have something that we have to do before we can recognize this as revenue, before we've earned it. Restricted revenue is donor-imposed instructions that we have to follow using these funds in our operations for our programs. So deferred revenue generally is money received before earning it. You owe something. Restricted revenue is money given with a specific donor-imposed limitations. And I'm repeating that because it's so important to understand that's the differences between the two and the definitions. Now, for deferred revenue, again, this is money received before we've earned it. Generally, it's for a service or a program, or it could be a contribution or a grant with conditions. The accounting treatment is going to be to record the liability. We're going to wait to record the revenue until the revenue is earned. So the reasons we may have to do this is because that the money received is potentially refundable. So we owe an obligation to the person who gave us the money. We haven't really earned that as revenue yet. The types of transactions where this situation arises is exchange transactions, where both parties get value. We get the cash, and the person giving us the money gets something in return. So the most common examples of this in a nonprofit is event tickets sold in advance of an event, membership dues paid up front. Do we have program or tuition fees before the classes or webinars start? And sponsorships with benefits. Do we have a sponsorship where they get a certain number of benefits? Now, a contribution with conditions is another reason that we would record a liability. We can't recognize the revenue until the conditions are met. This is a refundable advance, and it happens a lot with matching grants. It's the best way to describe it, where we have to maybe receive $10,000, but we also have to raise $10,000 in order to keep the original $10,000 from the donor. Recognition for these liabilities only comes when the condition or the service has been provided. And at that point, we're going to debit our liability, whether it's deferred revenue or it's refundable advance, and we're going to credit our revenue. So we're going to reduce that liability. We're going to actually recognize the revenue once the condition or the event or the obligation is released. So if you still owe a service or a benefit, this is deferred. Or if it's refundable due to a condition not being met, again, it's a liability, either deferred revenue or refundable advance. Now, I want to talk a little bit about donor-imposed limitations. Now, many times donors will give us funds with expectations of nothing in return. This is a donation, a contribution, and it's going to be contribution income. There's no conditions, or if there were conditions, the conditions were met. So then we're going to recognize the revenue. And if there's donor-imposed restrictions, then that's restricted revenue. We must recognize restricted revenue and also recognize the restriction in the net asset section. So we're going to create a net assets with donor imposed restrictions, and we're going to put the balance of the funds there. Now, the restrictions are going to be released either when the restrictions are completed. So if it's a budget-based, program-based grant, as we incur those expenses, we can release those restrictions. If it's for time, if the restriction is time, maybe for a future period, once we reach that future period, we can release those restrictions. And the reclass is between the restricted donor imposed net assets and unrestricted or net assets without imposed donor restrictions. Sometimes these donations are for endowments, and a portion of them will never be released. And we'll get into that later, but those are the kinds of restrictions that we could have on funds coming into our organization. Now, for the accounting treatment, we're going to determine if the condition is met or if there's no conditions that exist. And if that's the case, we can recognize the revenue immediately as restricted income. And we, again, classify the net assets as donor restrictions. And then, of course, the release when the restrictions are met. I want to talk a little bit about similarities and differences. Both the liability and the restriction, neither of these can be spent freely, but for different reasons. Deferred revenue is because you owe a service or a benefit or possibly a refund. The restricted revenue is the donor has set usage rules on how we can use these funds. So a simple thing to do to remember is deferred is a liability, restricted is net assets with donor imposed restrictions. You could have both. You could have a restricted grant that has conditions and you can't recognize any of the revenue until the conditions are met. And then once the conditions are met and we're recognizing the restricted revenue, that's when we get into the restricted revenue and the net assets. So we could have a combination. We could have a transaction that is a combination. And that gets fairly complicated, but it's possible. So just a quick kind of thing for you to remember. An exchange transaction is going to be deferred revenue. A contribution with conditions is going to be a refundable advance, also a liability. And then a donation with restriction is going to be recognized as restricted revenue. And then we're going to have the net asset classification. Some common mistakes that are made. Number one, recording grants as deferred revenue. Most grants are contributions and should be recognized as revenue, whether restricted or unrestricted. Now, on the rare occasion that you have a grant that has conditions, of course, you would recognize it as the refundable advance. As those conditions are met, then it goes to revenue. The second mistake is deferring restricted donations. Restrictions affect the usage of the money, but we recognize the revenue immediately. And mistake number three is not tracking the releases from restriction. This leads to misleading reports and compliance issues. My recommendation is we like to keep a rolling forward support spreadsheet that helps us get ready for the audit, where you have your beginning balance, plus your new awards, less your releases from restrictions, and then the ending balance. So we could do this every month and have the board will know exactly what the restricted net asset balance is. So that's a very common mistake that we see in reporting. So just to summarize everything, I would like you to, when you get money coming in the door, ask 3 questions. Do we owe goods or services? If the answer is yes, this is an exchange transaction and it's deferred liability. Now, keep in mind, as we talked about before, with membership dues, we could have an exchange transaction and the excess of the value of the benefit that the member receives could be considered a contribution. So when we get to the next step, if it's a contribution, does it have conditions? If the answer is yes, then it's a refundable advance, which is a liability. And we don't get to recognize the revenue until the conditions are met. A common example is the matching grant. And then finally, does the donor contribution have restrictions? And if yes, then that's restricted revenue, and you have to record your net assets with donor imposed restriction and your release of restriction as those funds are used for their intended purpose. So it can get very complicated when we're talking about grants. You could potentially have a grant that has both a condition and a restriction. Maybe you have a restricted grant that has a matching component to it. So these are things that you're going to have to look at. So I say, look at them in order, because exchange transactions could have a contribution element, and contributions could have both conditions and restrictions. So if you go through those three questions in order, it's really going to help you. Now, it really matters because this ensures that we're compliant with not only our grants, but with generally accepted accounting principles. It improves our financial clarity to the financial statement reader. We know what's restricted, we know what's owed back, and we know what we've earned as far as cash that's come in the door. And it really supports better decision-making for our management team and our board of directors. So I encourage you, now is the time. Review your policies on deferred revenue versus restricted revenue, or liabilities versus restricted revenue, especially before your audit. Review your revenue. Look for misclassification. This is a common thing. We tend to cash received revenue. That's not always the case. We want to make sure that the revenue is all earned. So those are the two things that I encourage you to do, especially right before an audit. I hope this was helpful for you today. And if you have any questions on this or other topics, we would love you to put that in the comments, and we will get back to you as quickly as we can. Of course, we always appreciate your likes. And thank you for joining me today. Remember, creating a bigger impact starts with stopping the nonsense. If you're dealing with nonsense in your nonprofit organization, we'd love to help you cut through the noise.